comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Hey guys, thanks for tuning in to another episode of Final Settlement. It was a fun podcast covering all things that have happened the past week and a half in the digital asset space. Positives around Bitcoin adoption along with altcoin mania coming back. Quick word and exciting announcement. You'll be one of the first to hear it. We just launched Onramp Guardian. Really excited to get this out because we've heard from the market all over the board as it comes to security with clients of Onramp and then prospective clients that are looking to leverage our solution, but have certain aspects of giving up what they deem as control as a negative. It's something that I talk to clients a lot about. Have clients have come on from 50 to $250 million and really explaining this notion of it's not all or nothing, but also where we're heading to, you're going to be praying for giving up that control as the market starts to realize you don't want hundreds of millions of dollars or even tens of millions of dollars in your possession. And so what Onramp Guardian does is effectively brings out withdrawal delays, deep fake protection against AI, instant freeze functionality, and then obviously our Lloyd's of London insurance. And then for private clients, it goes even deeper, really thinking through different withdrawal freezes, which has come up a lot, up to 365 days, custom velocity controls around the amount of capital that can move, and then a real proprietary 3FA protocol where you have to leverage the blockchain, specifically the Bitcoin blockchain, to move UTXOs around to prove that it's verifiably you in an objective manner. Really excited about this. If you want to learn more, if you're already a client, you could just activate it via the web platform. And then if you're looking to learn more, please feel free to book a consultation or shoot me a note. Always happy to hear from folks. Michael at onrampbitcoin.com. Now on to the rest of the show.
All righty. Welcome back to another episode of Final Settlement. Today is Monday, August 25th, 10:13 a.m. Eastern Time. I'm back in New York, boys. No more pretty beach skate behind me. How's your weekend? How are we doing? Big list today.
Big list. I feel I'm not 100%, but like 95%, which last week I was at 60. So I feel like, $1 million. I'm excited to chat. I'm in Nashville right now. Woke up. It was 59 degrees, which from like a native Texan in, August to wake up at 59 degrees is pretty wild. So feeling good and just ready for the spicy takes. It's too much bullshit, too much things getting thrown around that the market believes to be true that just aren't. So I'm going to try to bring the heat in this one.
Yeah, lots of different topics to get into. We'll talk a little private equity. We'll talk a little custody landscape, some new research that early riders put out last week. Maybe, though, where we're going to start is some news from the Trump administration. I'll pull up first here a Truth Social tweet, Truth Social post. I don't know what they're called. From the Don, it is my great honor to report that the United States of America now fully owns and controls 10% of Intel, a great American company that has an even more incredible future. And so this made some waves over the past several days in what is a pretty strong departure from sort of the typical level of government involvement in the private sector and a public company like Intel. The government just coming out and saying, now we own 10% of that. So there's a few other links that I'll find for this, but what are the immediate reactions and thoughts around this, guys?
Keep this one up for right now. There's so much in here that we could talk about this for a week straight. But one of them is in the post, he said the United States paid nothing for these shares. The shares are now valued at approximately $11 billion. That's not true. The money comes from somewhere. It doesn't come from nowhere. So they gave significant amount of tax breaks, as well as just, you could also say the United States paid nothing for these this amount of money that we printed during COVID, and it's now worth like $5 billion or whatever amount they did. And we all pay for it in inflation as well as taxes. In addition to see, there's it's difficult to see some winners and losers being picked when a lot of these large organizations continue to be able to have the ability to find out how to monetize all the tax breaks as well as they can. The smaller companies just don't have the ability to. Jackson talked last week about a family Italian restaurant in his neighborhood closing after 40 years because of the impacts of inflation. While Intel, which is losing money, gets additional stake and investment from the government. But it's when looking at this, it's interesting to see it's a departure from recent activity here in the U.S. of the government not taking any stakes in companies, but it's actually very common when looking at the broader landscape of how companies benefit from or the U.S. government or governments in general benefit from taking stakes in companies. So in the past, during world wars and financial crises, respectively, the U.S. government took stakes in railways as well as banks and AIG, et cetera. During the financial crisis, I guess, maybe we'll look back on this and say that we're currently in the midst of a debt crisis, which is going on, and that's probably why they're doing this. But when looking at other countries and what stakes in government or stakes in companies that they have, it's pretty similar to what you would expect. There are four kind of key areas. One, financial services like banks and potentially stablecoin issuers moving forward, defense companies and critical parts, and then the flow of key materials. So, I'm just looking at a list of other countries and what they've taken stakes of. The United Kingdom, coal, rail, steel industries during World War II, as well as 2008, the banking sector bailouts. France during World War II was automotive, and now telecommunications and defense. Germany, a lot of aviation. Italy, banking. And then kind of just going through the list, it's a lot of energy, production, oil, banking. So just key critical parts that go into economies, especially during times of turmoil. And it's really interesting that they said this morning that they're going to be taking share of additional companies moving forward, those that continue to get tax credits from the government. So I think it's just it's something to watch, and I would expect those key industries to get some more attention moving forward.
This makes no fucking sense.
Yep.
You didn't have a take. You just shared us a history on what's going on, but this makes it makes zero sense. Like, this is so insane. I don't even know what to make of it, because everything feels like when it comes out, it's just like, oh, we throw these things out of, God, I don't even know. What's the most recent new insane thing? Like, what was it? The Trump files, where they're like going to release him and they're not. And we just all laugh it off. Like, these things get thrown out that the U.S. government is taking 10% stake in a private business. And we just whoa, this was done before. And this is why. It's like, this is the most bearish take on humanity and the United States specifically. And the reason for it is it's very similar. We've got super co-opted in our brains. We've gotten co-opted from first principles thinking around the notion of the very often it's thought out of who will build the roads, right? We need the government to build the roads. It's no, that's not how it works. Humans, they deliver value, they create value, they have moral integrity, and ultimately, if the road around their community needs to be built, they will figure out how to build the roads. This is how all of humanity has existed. This is how we've delivered value. It goes across. It reminds me very similarly of the TLT pods where we talk about Jackson. He would bring up UBI on Bitcoin. It's just there's all these levels that we forgot to build in. And so going back to what this is saying is that we do not feel that the private market understands how to develop and create efficient technology. So the government is going to take a stake and help and influence that outcome, which we understand, the further we send our money away, the more inefficient the allocation of the capital. But then as that capital gets more inefficiently allocated, the more inefficient the outcome of the production. And you referenced it in when you kicked off what you were sharing about nobody will pay for it. It goes back to like another first principle thing that I think we like all missed is there's I think Brad Gerstner and who is it? Brad Gerstner and Bill
Gurley.
Bill Gurley were talking about whatever the new like save a child, like, and all these things always sound good. It's like where you're going to give a kid like $1,500 when they're first born, you're going to lock it up and it's going to get put into public markets. It's going to compound. It's like, well, that's somebody's money. Like, it's not free money. And is there a better use for that money? It's like, yes, by the family that like made it, and then they would save their own kids money or, you know, child. Like, if it's a free market endeavor, it's just ludicrous, but it makes sense because we're just in a weird, ludicrous world where the government's going to tout that from national security to domestic production, which brings up the other two parts of like, isn't this basically what like a mix between, you know, private and public market, like fascism is? Where's the line when you start to create? Is it, you mentioned some vehicles, but what about tech companies like Facebook? And then we saw what happened with COVID and how insane the government allocates any amount of resources. So the whole thing's preposterous, basically.
Yeah, I would agree with all that. I am definitely in the camp of this is pretty insane. Just in terms of a few things you referenced in there, like the blurring of the boundaries between public and private. I think this, while Liam laid out some historical precedent for these types of things, this explicit of a blurring, you know, hasn't happened in a really long time, at least in sort of public markets like this. And so the other big thing that sticks out here is like, this is very clearly, you know, if you've been listening to this administration over the past 8 months or so that they've been in power, like they have somewhat forecasted or signaled this in the sense that like they view specific industries as national security assets. And so like it's, you know, while it is a jarring move in terms of, you know, blurring those lines in a pretty explicit way, they have sort of been forecasting that like they view a lot of these things as almost existential to national security. But to your point, Michael, like it does, like this is sort of, you know, what you would expect the Chinas of the world to do is just, you know, take over certain areas of public markets. Like it is pretty wild in that respect in terms of what this does. Like the implications of it are, you know, prices, markets get distorted as a result of these sort of capital allocation decisions at the government level, where again, like, yeah, somebody's paying for it. And so that sort of inserts some amount of moral hazard into markets, into these industries, generally speaking, if there's a, you know, free money printer allocator stepping into the market and taking control of you know, at least parts of certain industries.
My two favorite parts are the notion of purchasing the stake in the company. You're pretty much it's like they're just really great gaslighting mechanisms in the sense of, if you wanted the free market to outcompete Intel, you basically assured with a move like this that they won't. Because imagine being an entrepreneur in any form and the U.S. government and your competitor takes a stake. Like, you're just, you know, what are you supposed to do there? It's unlimited amount of capital and involvement, whether it's government contracts. But the other one that's fun to bring up is, so the government's going to start buying stakes from national security perspectives of, you know, companies. Well, you know, there's a nice business over there that's sitting on, I don't know, the next world reserve currency. What is it? 550,000 BTC.
I think that feels more than that.
Yeah,
almost,
that feels
almost 700.
Real convenient to be able to normalize the notion of taking positions in businesses. So, yeah, good luck with that.
Yeah, it makes no sense at all. But I'm not condoning or supporting this, but I'm just saying it's the very early days, and it's going to happen even more and more. And it's very difficult to see for a company like Intel, because what do you do if you're the competitor? It's kind of just like what Bill Gurley talks about, just like all this amount of crazy funding that goes into, you know, the Ubers versus Lyfts. And if you don't take the money, then you're at a disadvantage to others. And same with all these late stage companies who are just being asked and flooded with money to go develop the new AI. It's not a great situation if you're the competitor and dealing with, okay, well, the government has a stake in my competitor. What do I do now?
Yeah. Wild times. But like Michael said, this will be forgotten about in a week. We just gloss over it and move on to the next thing, which is kind of insane. And yeah, I'm glad you brought up the MSTR point, which is obviously where, a lot of Bitcoiners took this on Twitter of like, maybe you'll think a little bit more critically about proxy exposure to Bitcoin and not actually owning the underlying and trusting a corporate entity to hold it, and also trusting layers of counterparty risk beneath that as well. Puts it into context that these things are possible, and if it's occurring with Intel, why couldn't it happen with MSTR? I think is a reasonable question to be asking. Moving on from there, there was a few private equity related tweets I saw that I wanted to share. This first one is basically a lot of PE firms, large PE firms, KKRs of the world, Bain Capital, Goldman, have started using commitments to continuation funds as collateral. So this is basically, indicative of a few things to pull out of this, but basically there's a liquidity crunch in private equity, generally speaking. Some numbers that are quoted in this Bloomberg report are distributions to investors have collapsed over the past several years. So what was around 29% of NAV being distributed about a decade ago is now 11%. So these firms are struggling to return cash. And so this is a clear sign of sort of a liquidity squeeze across the industry. And so they're resorting to new forms of financial engineering and sort of shifting risk around. And so to avoid sort of forced sales at discounts, firms are now using what are called continuation funds to basically use those new commitments as collateral for new borrowing. So this is some Ponzi elements to everything that's happening here and being described. Basically, financial engineering masking the underlying liquidity and these delays and inevitable markdowns that are occurring in the PE space more broadly. And so all of this is, adding to systemic risk and vulnerabilities in the PE space broadly. And, marks a shift that we've seen over the past few years with, exits being harder, basically masking over what are probably a lot of markdowns in these portfolios. And so just shifting the risk, shifting these investments into continuation funds, and then actually borrowing against those commitments as well. Any thoughts on this, guys?
I think the biggest thing is, this is the trend we'll watch for the next 10 plus years is counterparty risk and the insolvencies of various funds and sovereigns when it comes to all this misallocated capital. The numbers get so big that we gloss over, like when you hear a $1 billion fund goes out of business or marked down. We talked about it a week ago or 2 weeks ago, the Open Door marked down from $1 billion valuation to like $50 million. It's like that capital's destroyed, and his capital has been destroyed, an individual, an investor in the fund. And this is that reversion back to what we've been talking about in sound money and gold and Bitcoin, that the market's going to wake up and realize like the risk-free rate is whatever gold purchasing power looks like on an annualized basis, or BTC. And you don't have to go make these risky bets anymore. But the reality is we're going to play this out for so long, because if you think about London School of Economics, Chicago School of Business, like these academics and people cannot fathom that it's as simple as just buying one or two assets and then just going back to their life and trying to produce value. And their whole livelihoods are built around trying to either outsmart or extract value from the markets. So I see this persisting much longer, but we're speaking to the individuals that kind of get it. And that's basically underpins a lot of our investment thesis as well. It's like, who's delivering value to the world is the North Star, because if you're delivering value to the world, then individuals with value will pay for that. And whether it's in dollars, it gets swept into Bitcoin, or whether it's in Bitcoin, Onramp's a great example. People play us in Bitcoin because funny enough, one of the only things that are more valuable than Bitcoin is how you custody it, because if you don't custody it the right way, you might not hold it very long. So yeah, a lot of this makes sense. It's just unfortunate because it's going to take a while to play out.
Yeah, using leverage has been the prudent thing to do for these PE funds from 2009, 2010 to right up till COVID, and they're just they've gotten a lot of value that way, and so they think that it's just gonna go on forever. But unfortunately, that's not quite as valuable as just like actually investing in real companies that are delivering value. But yeah, it's gonna take a long time.
Yeah, and then the other link I wanted to share related to this is sort of on a similar but different track. And what this chart is showing is revenue growth as increasingly the key value creation lever for PE, generally speaking. So it's saying effectively like what was always sort of a game of leverage and cutting costs isn't really working. And so a lot of the exits that we've seen over the past 2 years are shifting a little bit more towards just top line revenue growth and margin expansion as opposed to levering up a business, cutting costs. And I think this is indicative of a few things, but effectively what has worked is starting to not work. And so this is a sign of people in PE land having to shift their strategy a little bit and focus a little bit more on actually, getting a company to produce value. I think the other takeaway from this could be just the onset of AI. Like maybe you need less leverage and the cost cutting is also still a component there, but you're just leveraging deflationary tools in a little bit more of an efficient way and just driving revenues a little bit faster than you otherwise would have. But any thoughts on this one?
Well, this ties into a little bit of the first conversation around we never tie back directly when we see housing, but specifically medical care and education, because a lot of these things are government subsidized. And you see them hit the highest amount of inflation, the administration costs, and the bureaucracy that sits at these organizations. And it ties back to like private equity. And I don't know the trade, maybe Liam could probably articulate it better, but you hear them talking about where private equity will buy like the medical facilities or hospitals, and then they'll strip them of like IP or any of the goods, like sell them off, and then they'll sell the shell to whatever, other subsidiary that's part of the government or government subsidized. Point being is you've seen this like extraction via the system and people taking advantage of it. It's not good or wrong, bad. It is the incentive model of the system. And that's where you get these like insane, healthcare costs and all of that. But point being is like what happens when more of the government goes in and has these misaligned incentives because the money cannon doesn't have the discernment of allocation that a general private market investor would have. You're just going to end up with more distorted outcomes. Going back to the first point is what we're seeing here.
Liam, any thoughts on this one?
I think it's difficult to tell just from this chart, but I think it's a little bit of a shift in terms of the types of businesses that they're really focused on, as well as just the proliferation of additional these strategies are very well known, and of just like, you need to cut your costs as much as possible. All of these companies are looking to do that prior to being sold to private equity companies, and so they can get the best valuation possible. And many of these people haven't actually run a business in the past, and so they can go in and say you can cut costs, but they don't actually know how to do that in a very reasonable way in order to drive potential returns and margin expansion for these businesses.
Yeah. Well said.
Hi, guys. Thanks for listening. I hope you're enjoying the pod. Just wanted to give a quick word from Onramp and Early Riders. You're probably familiar with our venture fund we operate, and we will be having some very exciting meeting of the minds over the next few months in Nashville around a few events happening at the Bitcoin Park, as well as in Dallas around the North American Blockchain Summit. We'll be having one-on-one meetings, private roundtable sessions discussing the status of the market, some of the exciting investments that we haven't publicly announced, as well as other ways for individuals to get more involved with everything we're building across the ecosystem. If you're interested in learning more, you can reach out to us directly. You can book time, or you can just subscribe to our research. We're going to be publishing a lot of these dates, as well as ways to get in touch via the Early Riders newsletter. You can view it at earlyriders.com. we're always excited to hear from individuals. We have some of the most sophisticated listeners and clients and investors and early riders. And I really mean that. We're working on kind of the bleeding edges of this space. And so it usually takes individuals that have had to think deeply and follow the space for a while to kind of pick up what we're putting down. But we love hearing from you folks, and also hearing about ideas or ways to get involved. There's no shortage of really amazing talent out there trying to kind of either take one step out of the traditional space and figure out what their next move is. And we love hearing from individuals like that because we're working on a lot of things, and it's really our job between the Guild Network, Onramp, and Early Riders, and some of our other portfolio companies to figure out how to help there. So I'd encourage you to reach out. If it's not this week, please keep it in mind as you navigate the space. We'd love to speak with you. All right, have a great rest of your week, and we'll be back with the last trade with a very big guest that we're super excited about. I don't know if Jackson will like that I share it here. So if you want to know, tag him on Twitter, and maybe he'll share it on Twitter. I don't want to steal his thunder. All right, have a great week.
Maybe switching gears a little bit, there were a few sort of just deals or announcements, and we can take this in any way. I did want to share this one. I thought it was relatively interesting. SoFi becomes the first U.S. bank to use Bitcoin Lightning for remittances. So this is through a partnership with Lightspark, which is David Marcus's Lightning service provider company. Pretty notable, just in the sense of a more traditional fintech, seeing the vision of building on Bitcoin as opposed to all these other various blockchains, and interesting in the sense that that is where the largest focus is in the stablecoin sphere, and you would expect SoFi to be thinking through use cases like that, but they've decided to partner with Lightspark on this one. So any thoughts on this?
I think we talked about it before. I just don't see how this is going to, at least today, matter. I think Lightspark has the A16Z ties. They're super, not only well capitalized, well connected. And so I think via relationship similar to David Marcus being at PayPal, like you can go to a SoFi, you can sell them a story. Lightning's been sold forever as a story, whether it's for payments and Blackhawk and all these things that never transpired with different firms. And very similar here. And to your point, like the outcome we talked about before is things the same here. It's like you just put it on the easiest database, which is the stablecoin database, and then you transfer it over like that. Like think about the level of education and permissions that you have to move over. I just don't see it happening today. Now, obviously 5-10 years from now, and for whatever reasons, from interoperability to, governance and potential, better from a censorship perspective and privacy, people would do this stuff on Lightning, but I don't see why they would. And then the amount of liquidity to make it material would happen there versus just on a public blockchain that is running some of these stable coins.
Yeah, it's another announcement of something that's coming in the future from a very large company. And sometimes these do or don't actually end up happening on the timelines that they expected. If you scroll up, there's something about implementing university money addresses too, which I don't know what that means. And seems like it's overly complicated versus just using the typical address schema. So we'll see if this ends up happening. But if you're not already, if neither side really wants Bitcoin, it's a little bit of overcomplicating things in my view.
Yeah, the fascinating thing with all of this, and this is happening across the world, and we get a glimpse of it in meetings we're in, is everyone is focused on these things that are sexy by whatever standards. And, the blockchain was this like in 2017 and 18 and STOs, and now it's real world assets. And then there's like payments and remittances. And it's not to say there's not innovation there, but it's just a hard thing for people to wrap their head around and then sell, that you want to be able to like house and custody this asset, store it, and then win your client bases. I think we should transition because I think Brian's been a little bit like, worried. I'm not going to go hard on him. I just want to he's like, all this like stuff is not news. Like, the news is like, it's altcoin season. Altcoin season is back. Season. If you can pull up that. I love Brian. Brian's been a key pillar of Onramp. So I don't want to, sour relationships. I'm not going to go so hard on his calls around that we're never going to see, alts and Bitcoin dominance go below whatever. That's not where I'm going to go with this. Just want him to know that. Where I do want to go with it is ultimately, this is going to get crazy. I've personally been saying it. This title says Bitcoin Whale wakes up after 7 years, rotates $270 million worth of ETH. I don't know if this is true or not. I have no reason to believe it's not true, because in the same way people and large holders of public equities and other assets can manipulate markets, it's the same way where large holders, I think this is tied into some of the sell-off from the past 24 hours, that the person, potentially was manipulating the market to be able to buy back lower, in the same format that there's large holders that play both sides of the market, and that as the Bitcoin, you can go back and forth between altcoins and Bitcoin. But the other, we don't have to pull them up, but I just had them in this channel. If you give me 1 second, I want to rattle off just how wild what's about to happen and what's coming is. So just, read them off real quick. So the past, let's call it 48 hours, past 2 business days, Grayscale and Bitwise filed their amendments for the XRP ETF. There's a former Bitmain exec launching a BNB treasury, targeting $1 billion raise. Grayscale also files an S1 with the SEC to convert its Avalanche Trust to an AVAX ETF. Galaxy Jump and Multicoin seek $1 billion to create a Solana treasury. Van Eck proposes JIT Sol ETF. Hold that one of your thoughts, because I'll come back to that. Or maybe we'll go back. So that JIT Sol one, very similar to, I think it's Hyperliquid. So I can't help but bring up a little bit of, this is where the fundamental discrepancy between Brian and I were, is that only 1% of the market roughly knows about any of this stuff. So it was kind of insane to me to believe that 99% of the people were going to just bypass the noise, was one. 2 is the institutions love this stuff. In the same way the individuals were the test bed for just all, again, the mental gymnastics around yield generation and all these crazy things. So they're going to parlay that into these frameworks of ETFs and public treasury companies that will generate passive yield by these other insane strategies that blew the market up in 2022. And then the last part is crypto, including Bitcoin, has been insanely historically been insanely hard to get spot possession of, right? This is just pure why the ETF has had such large demand, and even MicroStrategy. Because if you really think about it, for anybody listening here, it might be pretty simple to go log into an exchange and buy some Bitcoin, maybe figure out how you're going to custody it. For the majority of people, that's a very hard proposition. It's the way to either use the mental model. If you were to go set up a gambling account, you're going to go set up some third-party weird place that you're going to end up at. You have to move your dollar from your bank account. Hopefully they land over there. You have to buy the underlying that is a magic internet bean, and then you have to move it off into some other third party if you're going to actually secure it the right way. That is not easy. So these ETFs provided that. Point of walking through that is when you think about Hyperliquid. I don't even know what Hyperliquid is, but I know Brian does, and he shared it multiple times. It's my understanding that this Hyperliquid token is very hard to find on any exchange. So if somebody's going to give you what they're called DATs now, I guess, digital asset treasury company, to give you Hyperliquid exposure, they're going to generate yield. Think about the amount of people in your old networks that are going to love that thing. So anyway, altcoin season is here. It's going to run rampant, and I'm sorry, Brian.
No need to apologize. I'm willing to admit I may have been overly optimistic about the understanding of Bitcoin being different than crypto. It's not even that. It's not even really the distinction. It's just the greed and animal spirits that still exist, and people see a way to make money, pump these things, and you might be right. We might just be at the sort of beginning gates of that. And if I'm being honest about it, I think 50% dominance is now in question.
And you know
I will pull up BTCD I just want just for reference of where it was. It was around 65. It's now at 58. My call has always been 50%. There's a lot of resistance there. We'll see what happens. I will also point out, though, that the ETH BTC ratio chart, while that's been spiking over the past month or two, it's still off its highs of 21. So in Bitcoin terms, Ethereum hasn't made a new all-time high. I would say alt season's really here if and when that does happen. If we see this ratio continue to go up above its previous all-time highs, then I would say 50% is in jeopardy.
Yeah, Yeah, I mean, this is the hard part about where we've gone back and forth, and this is like the thing we want versus the thing that's going to happen are fundamentally just different. But it reminded me of it, and this is just timely. You, out of all people, should have been on to this trade and how it was going to play out, because a year ago today we were at the SALT conference in Wyoming, and really great from a just like
boondoggle perspective.
But boondoggling from an environment, right? Like Jackson Hole in late August is just amazing. But remember just the amount of, you sat there, you wrote a whole piece on the noise that was there, and that was the canary in the coal mine. And you can imagine, so it happened again this past year. Heard great things from, again, the environment, but very similar when it comes to the environment from, the signal to noise ratio around digital assets and all the things associated. So yeah, this is just a sad state we're at. It's also the alpha in the market on just holding spot and businesses that will accrue it. But yeah.
The other thing I would say is like, probably should have known better once Trump coin happened, and it became very apparent that the administration was not just leaning into Bitcoin, they were leaning into everything. And that gave the air cover for everything. So I do think that's been a factor as well. Probably would have happened regardless. But all of these DATs and broader institutional interest in all these other assets, I think, is also a reflection of just the administration's stance.
It's that, plus it's also just the key players in the industry who, for better or worse, are looked at as like the largest in the suits, like the Bitwises, et cetera, that are going into and leading
Tom
into
Lee.
this. Galaxy, Tom Lee. I think Brian Armstrong tweeted Balaji coin over the weekend, which had like $3,000 in market cap or something to that degree. All these people are not just interested in Bitcoin, and the market perceives them as to be the best educated. So until that changes, we're probably going to see alt season continue.
Yeah, maybe you can click into the other link because that ties directly into the rent extraction.
Which one?
There's a rent extraction link. I think it's titled. It was right below the last
Got
one.
it.
So this reminds me of this conversation that Liam just kicked off around the suits and whether it's Brian Armstrong or Tom Lee. Very similar to the gaslighting and the government buying a company that looked at anything anyway positive, in the same way that most individuals that were coming from TradFi and even probably some listening would think we're either Luddites or there's some innovation happening here. But we've had 15 years to show empirically that there's no objective value being delivered by any of these blockchains. Even the stablecoin aspect, if they really wanted to, from a consortium level, can adopt this. The banks compete with each other, but we all believe it's going to end up back there at some consortium level, because even at the stablecoin level, you can seize and censor all the transactions. Now, they do obviously offer innovation from like Rails, but the European Union has known to have like great kind of like connectivity when it comes to banking. Like, it's not as innovative to be able to send dollars from a bank to a bank. And so we've seen this play out. And so these tokens that are filling the DATs and the ETFs have no underlying value. Nobody's deliver them. And at least from the architecture, we could talk about multiple layers on Bitcoin and where you would, have some of the stuff derived from. But point being is, so it's been rumored the past couple of days that I think it was the Block and then Blockworks that 21 shares. So it looks like 21 shares ETF would invest in crypto ETPs, futures, and equities, active management. Lets us move beyond simple exposure and deliver strategies that adapt in real time to a rapidly evolving market. Head of U.S. business, ex BlackRock. And then if you scroll down, it says the firms looking to launch these two there will be a lot of crypto exposure for investors to choose from in the coming months between funds and equities. Tons of experimenting from ETF issuers to see where demand is. I doubt it will last. So it shows a 2x long Doge ETF, a 2x long SUI ETF. There's discussions around Bitcoin's volatility or concentration might be a problem for 401ks. So now you're going to have mutual funds that have a basket of cryptocurrencies. We've seen Bitwise in particular for years have a basket of top 10. The fun part about talking about this is like there's actually receipts out there where Bitwise have launched multiple things. Like there was the Metaverse ETF with Multicoin that they scrubbed. You can still Google and find it online, but they scrubbed it from like their website and any like, lasting, because these things, they're just kind of, it's rent extraction. It's the ability to take individuals, come into the space, they're looking for quote unquote alpha, and then you sell on products, you take your crazy management fee, including in these DAT structures, and ultimately people get left holding a bag of effectively zero, or close to zero. And yeah, we're just going to see this at a much greater scale now that the plumbing is all opened up into these DATs.
Yeah. This is insane. This is crazy. This is a bull market for noise. Like, this is going to hurt a lot of people. 2x long Doge, 2x long Sui. To your point, there's no underlying value in any of these things, and you're layering on not only leverage, but counterparty risk, execution risk, all these things to something that doesn't even have fundamental value to begin with. So this is not great to see. A little disappointing, but to your point, this was kind of inevitable, and this is the world we live in now. So expect more of this.
I feel like we broke Brian.
We're dead.
Well, it may take a long time, but eventually this market structure will break. People don't really look for a basket of diversified precious metals. People know that gold is the best. And just like that, they will know that Bitcoin is the best and only digital asset. There may or may not be a place for other of these that are significantly smaller than Bitcoin, but it's going to take a very, very long time to get there.
Yeah. We mentioned Wyoming. I know Michael doesn't like when I read tea leaves, but there were some heavily discussed words from Jerome Powell last week in Wyoming. Effectively, what some people are looking at him abandoning the 2% inflation target. Now, I think that was a little overblown, but again, all of these are just words. They don't really matter in the grand scheme of things. But if we are to look at what he said, it is a bit of a departure in the sense that they're not really focused on inflation anymore. And there's various reasons for that, but they basically know they can't get it to their target of 2%. So they're sort of tacitly abandoning that target and instead focusing on a weakening labor market as a rationale to cut rates. Now, the reality baked into all of this is that they have to cut rates regardless of their excuse for it, because the interest expense on the debt is over $1 trillion right now with rates where they are. So they have to bring down rates. They have to print money. And this is all just words. But as Macroscope points out here, lots of debate around the meeting last week. He's saying they didn't technically abandon it, but they are signaling basically their intent to abandon it at some point because they can't get it to 2%. And then also just shifting the focus from inflation to the labor market. Another tweet to share here from Kobayashi. This is sort of what I was alluding to. They were going to blame the weak labor market. So they're just going to forget about CPI, which has been above 2% for 53 straight months. And so naturally, this is pro risk assets, pro Bitcoin, pro gold, all of that. And it should be seen as a bit of a pivot. They're shifting, Powell also said, shifting the balance of risks may warrant adjusting our policy stance. So basically that is foretelling a likely September rate cut, again, blaming the labor market as opposed to inflation, which they can't get back down to their target. Maybe one other notable thing from this was just the market reaction to it. So right after these comments were released, you see gold spike and the dollar collapse. Thoughts on this, Michael? I know you hate the Fed and tea leaves, but I thought it was important.
Yeah, I mean, I don't necessarily hate the Fed. I think it's just all gaslighting. We talked about it a week or 2 weeks ago about the Warren Buffett, like the short-term noise is noise. I think the key thing I took from there is I thought for weeks, if not months, they were consistently saying that the job market was great. Right. And we know the job market and inflation aren't great. It doesn't take a rocket scientist to go and see what it costs for anything, or to see friends and family either not having jobs or being stuck. There's all these terms about like job hugging, where people are just fearful of leaving. There's crazy numbers on like the amount of movement of jobs, and like it's like at a 50-year low because of there's just there's no other opportunities, or people understand that there's very limited opportunities. So yeah, I think this all like aligns, right? It's just like what's the flavor of the next Fed meeting on, how do you spin the narrative? I think the reality is we're just going to be in a much higher inflation than 2%. So now you have to start to figure out like what is that mix and goes into it, to kind of get people familiar with how we're going to be at persistently higher inflation, at least in those terms. Whatever number they give us, you're going to be able to probably add 10% confidently and know that that's what real inflation is. Hey guys, I hope you're enjoying the podcast, and it wasn't too doom and gloom. Really just try to share what's currently happening in the markets, how we see it. The altcoin craze is something that sadly will persist, but I believe if you're listening to this podcast, you probably understand that and think deeply about Bitcoin custody. And just a quick word from Onramp. I'm sure a lot of listeners know of the different offerings that we have, whether it's, multi-institution custody, the ability for our trade desk, lending and inheritance, and then the Dynasty Trust, which we are really excited about. We have no shortage of exciting things coming out this fall. Really, I think industry shaking things across the landscape. We have a lot that we've been working on. The one that I just want to go a little deeper on is Guardian that we announced today, and specifically the proprietary, and I don't even want to call it proprietary, but the 3FA. 3FA, we're really excited about that because ultimately it's something that severs the internet connection from the movement of your Bitcoin. So whether it is, video verification, multiple institutions verifying that, 2FA, logic, time withdrawals, those are all put in place to protect client assets. But at the end of the day, they leverage the internet connection specifically from a subjective view. How do you interact with humans in the logic? 3FA takes that a step further and really relies on public-private key cryptography, specifically around Bitcoin wallets, and the movement of certain UTXOs for a certain client-specific PIN. This is something I've been thinking about deeply. It might be overkill for somebody with, call it $1 to $10 million, even though it's still open for them. But for clients that we work with that have tens, if not hundreds of millions of dollars, this is something that I think they're going to be really excited about because ultimately it takes it a step further and leverages either a hardware device that we would ship them or another way that they've generated a private and public key. So if you want to learn more about that, you can look at the blog post, or you can feel free to book a consultation. If you want to talk with me directly, again, Michael at onrampbitcoin.com. And hope you enjoy the rest of the show.
Yeah, I actually read it a little bit differently. I thought that they were moving away from the 2% inflation over time that they authored back in the pandemic and moving back towards the target of just 2% inflation, meaning that they might be a little bit more restrictive than we had thought. I think that Powell probably wants to protect his legacy of, running too hot on inflation. And then if he's not able to really tame it, then he likely will he wants to fix it. Like, he doesn't want to be the guy who had super hot inflation over his term, and but he also doesn't really want to crash the labor market. The labor market, to your point, like the job switching is at a record low. New hires is like very, very low, both below pre-pandemic trends. So they're stuck between a rock and a hard place.
Yeah.
No, that's all well said. Maybe one other just headline, Liam, I think you shared this one, but the Philippines thinking about a strategic Bitcoin reserve. I don't know the likelihood of this.
Yeah, I think it's extremely low, but if you pull up the link there, it's interesting to see all of the different data points that they mentioned, like in Central America, El Salvador already adopted Bitcoin as legal tender and began to purchase and hold in reserve. Brazil introduced sovereign strategic Bitcoin reserve. In the European Union, Switzerland is now considering it alongside gold. In Germany, the former finance minister has suggested that they reduce reliance on USD and consider Bitcoin as a way forward. Poland considering Bitcoin reserve. Hong Kong has advocated for it too. The Malaysian government has started to consider the use of this. In Russia, they've begun to use Bitcoin and other Western digital currencies for international transactions as part of the strategy to bypass Western sanctions and reduce reliance on USD. And so this in itself is, I doubt that the this Philippine one gets passed, or that this is really meaningful in itself. But just taking a look at this kind of laid out and how much the Overton window has shifted from the past 2 years, I think is just interesting to see. And regardless if they do it or not, I think that there are going to be a couple countries that do it over the next 5 years or so, which will just continue to move that window over even more. So just like we've seen Harvard allocate to the Bitcoin ETFs, we're just going to see it go incrementally this way. And it's interesting to see how they laid it all out like this and how far we've come.
Yeah, I agree. In a sea of noise as well as pessimism around the status of just kind of like misallocation of capital, the notion of a congressman in the Philippines drafting this bill and then all the other anecdotes Liam shared is very positive for that, like, kind of domino, just next domino to fall, whether it's Philippines or somewhere else. And then it really ties back to the notion of where we've shared, if like the next, call it 18 months, you see the sovereign adoption and accumulation step in, things get really interesting and accelerated versus like the traditional markets or traditional Bitcoin markets when it comes to halvings and just cycles. I don't think they go away, but I think they take a completely different form if you have sovereigns globally that have access to what's effectively unlimited dollars and also energy to be mining, step into the market. So I do think it's a positive direction, independent of like the likelihood of, the Philippines accumulating Bitcoin.
Yeah, no, it's well said. Some signal in a sea of noise. Whether or not this gets passed, it's the Overton window continuing to shift with respect to Bitcoin as a reserve asset that you would want on your balance sheet as a sovereign. Michael, there was one other stablecoin related link that you had shared from Layer Zero Labs. Is this the Wyoming stablecoin? What was the takeaway from this?
Yeah. So I think I love Wyoming and the people behind this and know them, consider them friends. I think it's cool to see Wyoming lead in digital assets. My understanding that this is the first stablecoin that's been launched on so many blockchains, Ethereum, Solana, Avalanche. It's my understanding it's not necessarily a stable coin. It's a stable token because of it being issued not by a bank, but by the sovereign state of Wyoming. The thing what stood out to me, and I don't mean to be pessimistic about this, but I was thinking about it last week, independent of the Wyoming launch, was that the notion of the CBDCs are here. They're just not called CBDCs. Because where this all goes is we're going to have, I think, very few people that pay attention to digital assets, and Bitcoin would say that we're not going to go to a digital world for dollars and the movement of dollars. And they naturally have to become interoperable because it's just inefficient for them not to. So however that manifests, again, directionally don't know. It's the same way we talked about the yield being generated on stablecoins. We don't know how it's going to happen, but we just know market forces will determine it or require it. And similar to like Coinbase doing whatever they're doing in their arbitrage from like marketing dollars to pay people back for using it. So it's not yield by a circle. Point being is everyone's friendly until the draconian measures come in. And it goes back to the state private public partnership. We saw this happen again during COVID. It's not about being conspiratorial. It's just the reality of when you have government, sanctions and forces and policy for the greater good, whatever the greater good is marketed at the current time, you will naturally be able to now effectively like just halt any movement of capital. And so you're starting to see this. And again, it's marketed, it's spun as a positive where what's the recent knowledge around like HSAs and Maha and like, okay, so you're going to get like your HSA and then maybe that's going to be digitized, but you can't like buy, Coca-Cola or sugary stuff, right? Well, like that's how it starts. But ultimately you're basically saying with a click of a button, you can programmatically determine what people are going to buy or not buy. So again, it's going to look like a positive for the industry. It's going to be, I think it's positive for Bitcoin because more capital is going to come in because, you have a digital dollar and you can just it's more interoperable with BTC, but I can't help but see this is just kind of like, not going to play out very well for a lot of people long term.
Yeah.
I would agree. I think that Tether and Circle are pretty much just like half a step removed as well, being overseen by Congress as well. It's pretty much just all the same thing, and using. We've already started to see this with Choke Point 1.0, with the restriction on guns, payday loans, etc., and debanking of those types of businesses. The flow of funds and tracking that, and as well as just the then permitting what you can and can't buy, will probably continue to heat up moving forward.
Yeah, it's a slippery slope for sure. It will be positioned as innovative and necessary, but there are some seriously negative potential externalities from all of this continuing to flow this direction. Maybe switch gears a little bit here to some research that early riders put out last week. Michael, I'm going to pull up your tweet first, and maybe you can speak to sort of high level of what we were trying to accomplish with this report, and then I'll pull up the report.
Yeah, I think at the core, I've been hesitant to say this, but I feel a lot more confident it'll still be polarizing. Is we're so early to Bitcoin, we hadn't even figured out custody yet. The tweet, I know Bill Ackman gets a lot of crap on Bitcoin Twitter, but it's a really apt quote that he had, which says, institutions cannot self-custody without severe regulatory issues. And that's just one issue, not just regulatory. Most individuals would prefer not to self-custody. Crypto will remain a sport for hobbyists until this is fixed. And so this is something that we've been talking about, thinking about, really the notion of how do you get access to Bitcoin without the trade-offs of, a third-party custodian and all the other layers of intermediation between an ETF or Bitcoin or a treasury company. But then also, again, the reality is, yes, it's very easy for anyone on the planet Earth to put $10 or $1,000 into 12 words or a hardware device, but it gets really hard for somebody to put all of their wealth. And I think that's the big gap that most people have been missing is, again, if Bitcoin's speculative asset and people want to play around, it's very easy to put a little bit of percentage in any of the existing custody solutions, whether it's a hardware device, collaborative custody, an ETF, Coinbase, et cetera, et cetera. But if you're going to think about Bitcoin permeating in everyone's lives and every aspect of society in the same way that the internet did, you have to bring standardization across the board. And so this piece breaks it down, and it references different formats like the SSL of Bitcoin, tying back to encryption and how if anybody old enough remembers, or your parents trying to buy anything online, they would never put their credit card information online. And now that's looked at as standard via encryption that's based online. Linux, very similar in an open standard for building blocks on top of different software and hardware. So this was just a very nice piece that the early writers team put out, and I think it's worth a read to kind of see how this goes. The iPhone is something that gets loosely thrown around a lot, iPhone moment, but there's good examples of once you have a product that kind of collapses and disintermediates a lot of either physical or software into like one unique kind of construct, you can start to really innovate and bring things. And so an iPhone's a great example where GPS being included in your pocket now started to allow for you to hail an Uber or a car that, historically taxi cabs were like 1/10 or 1/100th of the amount of demand for rides because you didn't have the technology to manage it. And that's just a small example. So I think very, very good read, and then also gives a good lens of not only how we look at the market, but the opportunity that we invest in. For if we're so early that custody hadn't been figured out, then there's a wide open opportunity to bring standardization and then bring a lot more effectively capital and users into Bitcoin. And that goes from individuals all the way to whether it's credit unions, credit funds that are allocating to the space that need a more redundant, resilient architecture when you're doing Bitcoin-backed lending, to insurance products. So I highly encourage the read if anybody's interested.
Yeah. Go ahead, Lim.
I was just going to say, building off that, I mean, like we're still in such early days. I couldn't help thinking of Steve Jobs initially trying to sell computers not actually built to retailers and allowing them to build it themselves, and he didn't even understand that that's not necessarily what they wanted. forcing people, or not quite forcing people, but just like telling people to if they want Bitcoin exposure, to become hobbyists and figure out how to manage all of their wealth in hardware devices or however they want to custody their funds, is just not something that is super interesting to a lot of people. And there's always specialization, because that is just how the world works. It's just allows people to be more efficient with whatever they're doing. And so rather than just trying to convince everybody to be a hobbyist when they're potentially going to lose significant funds if they don't manage it correctly, or keep them out of the market, is just probably not how the entire world is going to work moving forward. So yeah, I would highly encourage people to read this. It kind of just goes over the historical arcs of other technology and how this is kind of applying to Bitcoin today.
Yeah, really great piece. I think what stood out to me, or at a very high level, it does a great job of sort of walking through what has traditionally happened with emergent technologies. They go through these various phases where initially the hobbyist phase, there's a ton of friction embedded in using the new technology. So whether that was PCs, some of the earliest cell phones, or internet protocols, there was a stage there where it was very difficult to use. There was a lot of friction, a lot of learning, and effectively that's where we are with Bitcoin custody. Because Liam, to your point, people for the last 15 years have figured out self-custody because they knew the alternative was probably suboptimal, i.e. trusting a single custodian. So they were forced into this niche hobbyist endeavor of figuring out how to secure their in a lot of instances, the majority of their net worth via cryptographic material, hardware devices. And there really hasn't been a way outside of single custodians to broaden the access, reduce the frictions associated with holding this asset in a risk mitigated way. And so in our view, multi-institution custody pioneered by Onramp really is that breakthrough for Bitcoin custody, in the sense that it distributes the counterparty risk. It's risk mitigated sort of at the base layer, at the protocol layer, using Bitcoin native multisig. But importantly, it abstracts away the friction of the end user in terms of securing key material themselves. And so it's this really elegant infrastructure approach that I think opens the door to just a lot more innovation on top of that standard, but also just more adoption of the asset, because it's simpler, reduced friction for someone to onboard, own the underlying in a risk mitigated way, where they don't have to do it themselves and be that niche hobbyist. So this walks through the various examples at length. And the other thing I would point out too, to just note here, is like, the stakes are different when we're talking about Bitcoin custody relative to these other technologies that emerged and went through these phases, in the sense that, if your early edition of some cell phone craps out, doesn't work, or, you can't log onto the internet for whatever reason, you're not losing your assets. You're not losing your net worth. So there's obviously negatives, and it was clunky to use these different technologies, but Bitcoin and Bitcoin custody is a different level of stakes and what's at risk for things going wrong. And so that's why I would say this sort of infrastructure breakthrough is even more important than some of these ones that we're making parallels or analogs to, in the sense that the stakes are just much higher. This is people's money. In many cases, it's a large percentage of their net worth, and they can't afford to have those frictions that ultimately could end up in a catastrophic permanent loss. And so it is it's different in that sense. But go ahead, Mike.
Yeah, it's well said, and I think it ties back to, there's a lot of historical precedences and influences to where we're at, and why it hasn't been done is simply because, again, we're so early. But when you look back at, again, there are multiple disciplines, but when you look back at the mainframe computers and what had to go into effectively like a mathematician or an somebody that's managing accounting to code up what the logic would be, there's great references on where you'd have to like not only build the logic, but then you would hand it off to somebody that would go and like punch these cards that almost look like folders or like an envelope that would be plastic, and you'd have to like get the holes in the correct way. And if you messed up, and there were stacks of them depending on how complicated the formula was, and then you'd have to put that into the mainframe computer. It's like there's a lot of like precedents to look at, well, okay, that was used by certain individuals, but over time you have to democratize that access. But then on the complete other side of it, when you think about goldsmiths and the notion of like gold monetizing in real time, the reason where a lot of this stuff is still taboo and why there's a lot of opportunity for us is because in Bitcoin's first 15 years, the logical way to custody it wasn't self-custody, A, because this didn't exist, but really B, the asset was so small. So there wasn't really the significant losses that you had at stake. Now that a Bitcoin is 112,000 or whatever it is. And then what you need also when you think about like Dynasty Trust or insurance or these other products and services that are out there. So for 15 years, it was the thing to do is self-custody because third-party custody, ultimately you couldn't trust. I'd still make the case you still can't because it's just code. It's just Bitcoin private keys. They're just data. And at the end of the day, all data will eventually get leaked in some capacity. We've seen this historically. And so when you look at the historical precedents, it's very similar to gold, where a bunch of times people would leave their gold buried in their backyard or on their land. They'd give it up to the church or a third party family member. But all those things don't have, congruence, accountability. They miss a lot of the natural functions for coordinating economic activity. And that's where the goldsmiths were introduced. And then we obviously went away from the goldsmith as you created notes and, the different, claims on it. But very similar here, where it's just thought of as a second order, like custody's been figured out because we figured out how to hold, the private keys on a hardware device or trust a third party ETF. When for 15 years, it's been proven that it hasn't worked because we know that for every one person that gets kidnapped, hacked, loses their money in a wildfire or all the things associated, there's 100 others that haven't come forward for a number of reasons. And then again, the last big blow up was only 3 years ago. And that's where the market completely delevered because of the lack of transparency and all the things associated with centralized custody, let alone hacks. And so it's just something that the world and the market works in a very 2D fashion. And so it's like what all that we've been given is what we assume will be there. But that's the definition of like what's obvious is obviously wrong. And so I think this piece does a good job of it, but we'll continue to do more because when you look back, history it often rhymes. And when you look at computers, when you look at banking, like the notion that we're all going to just be our own bank, it's not even technically that it's impossible because it is for every, 8 billion humans to hold their own UTXOs. It's actually from a socioeconomic perspective, nobody wants to be their own bank. Even the people that scream the loudest about self-custody, I can guarantee you they go to sleep at night not feeling the greatest that all their wealth is held on 12 words, that God forbid they get hit by a bus and they haven't set up the total protocol for their family to get it. And again, it's not an either or thing is the beauty. It's the same thing as money, is if we don't hold all of our cash in the bank, like you may take some home, you may have some in a rainy day fund, you may have these different options. It's just explaining the standardized process for the vast majority of wealth will end up going down this trajectory.
Yep. Very well said. So we'll link to that in the show notes. Check out that report. In a related item, just thinking through custody risks, there was a report from last week of a social engineering attack. We've been seeing these increasingly over the past really almost 2 years now. I feel like we've been seeing increased news items, whether it's social engineering or physical attacks in the crypto space. So this happened to be a social engineering attack. A victim losing almost 100 million in Bitcoin. They were using what it seems like is some hardware wallet that then there was an attacker posing as a support agent for said hardware wallet, getting them to effectively unveil a certain amount of their cryptographic materials or passwords or logins to the point where they could then siphon funds. And so this is, a continuation of a trend that we've seen. On one hand, multi-institution custody, broadly speaking, defends against these, but I wanted to pull up a announcement from Onramp just this morning. We went live with what we call Onramp Guardian, which is basically even further protection. So going beyond the custody layer and thinking through how do you defend against basically the unauthorized movement of your Bitcoin. And so sort of the first defense against that is just superior trust minimized custody through multi-institution, but basically wrapping around that various elements of basically just, the ability to slow down the process, the ability to put in enhanced identity checks, time delays, velocity limits, and enhanced fraud detection as well. So using AI to combat AI, deepfakes potentially, and really just doing everything in our power to add an additional layer of security around what we believe is sort of best-in-class custody. But Michael, anything to add on Onramp Guardian?
Yeah, I think the spoofing stuff, randomly, I had a dream about spoofing. I was thinking about pitching Sailor. If we won't go far into Sailor's actions and intent, but Sailor pitching him on MIC, and it was this notion of spoofing, because what Brian was alluding to, there's a lot of already value and assurances and security with multi-institution. One specifically is around the notion of, even if a key signer was somehow spoofed by multiple versions, that would take different levels of an organization's coordination. The beauty of multi-sig is that because it's interoperable and because the signatures happen in a segregated fashion, one address or one signing is completely independent from the second one. So you can't manipulate the second signer to sign a malicious transaction if it wasn't authenticated via the person. So there's a lot there with video verifications that go into multi-institution, but to take it a step further, given not only the physical attacks that have been occurring, but also the social engineering that has increased, there's a number of levels, from whether it's a lot of folks concerned with AI and the deepfake protection to leverage AI to combat AI by using the ability to tell if somebody is actually there or not, it's a real human. The withdrawal delays have been something that clients have been asking and using already, because depending on markets, and also this goes back to just market understanding, that if you know that you're an on-ramp client and it's going to take either days, if not weeks, if not longer, to move the assets, you're automatically, because there's certain aspects of this that doesn't matter, it gets thrown out a lot. Well, if somebody has a gun to somebody's head, they are just going to tell them to move the money. It's like, it doesn't work like that in banking wire, in the same way it doesn't work with on-ramp. Like, there is a SLA in process independent of what's happening. And that's also why you may want some form of self-custody, because you may want to give them something. But then layered on top of that, there's obviously the insurance, there's freezes in case there's the ability for somebody to get access to your account. But then there is a new 3FA protocol, which effectively severs the internet connection to objectively prove that it is you with a certain amount of Satoshis wanting to move from one wallet to another. That's limited to private clients for now, but we can talk more about it if you ever want to book a consultation. But I'm personally really excited for that, because we have clients that hold, $250 million plus in assets, and significant wealth is stored with us. And there's a notion of, at the end of the day, a lot of things end up subjective, whether it's passwords or can be manipulated, spoof, video verification, that certain holders will want to sever that internet connection and have an objective opportunity to show via the blockchain and Satoshi's, UTXO's move, that it is them verifiably proving that they are moving this amount of assets. And if they don't, then the account naturally will go into a freeze. Really excited about Guardian and just really adding to the value. Again, this is similar to insurance and the other products we've launched. There's no additional cost for this, which is something that is important for us. That the idea is we're not just a custodian, we're a private bank for Bitcoiners. And you want to be able to deliver as much value as possible, whether it's trust planning, estate planning, inheritance, or the just ability for your friends and family and bad actors to know that you can't just take somebody's assets, independent if you show up to their house or not.
Yep. Very well said. We'll link to that in the show notes as well if you want to learn more or reach out to any one of us. One other, before we wrap, I know we're up on time, but there was one other headline related to all of this, related to custody risk, particularly at the corporate Bitcoin treasury level. Michael, you had shared this one. Corporate Bitcoin treasuries could raise credit risks, Morningstar says. Regulatory uncertainty, volatility, and liquidity challenges could all elevate the credit risk profile of firms adopting a crypto treasury strategy. So basically, my understanding of this was Morningstar and other credit rating agencies are looking at a lot of these Bitcoin treasury companies and DATs and saying, effectively calling out custody as a really important risk to consider, something that we've talked a lot about on this show, seems to be impacting, or at least, entering the mind of credit agencies looking at these companies.
Yeah, I think this ties back to everything we talked about with the standardization. if you're a corporate rating agency, you're looking at a public equity, whether it's let's forget about digital asset treasury company, just a traditional market public listed company that holds a significant amount of BTC in its balance sheet. Figma is a great example. It's in Coinbase's ETF. But if nothing happens to Coinbase, what part of the credit rating starts to take a hit if Coinbase is holding trillions of dollars and there's no form of insurance that will provide, insurance for that? Let alone, well, what's the strategy? Like, is it in cold storage? Is it verifiable on chain? Are they lending against it, doing other things? Now, these might not seem like a big deal today, but as the asset appreciates, because we're again only at 112K, so $2.5 trillion market cap. But what happens at 5 trillion, 10 trillion, and these risks come back? Because they will. Like, it's again, we're in the Wild West. We've never had a digital bearer asset worth this amount of capital online. There will just be increasing volatility when it comes to counterparty risk. Like, I can hang my hat on that. And if that's true, then there will naturally need to be standardization, not only the ratings of who's holding it, but then how are they holding it? How is it verifiable? And insurance is one of my favorite ones to bring up, because I'm very confident insurance in this industry has not been solved yet. And simply because most insurance companies are insolvent. We all know this. And so you should never rely on your custody arrangement because it's insured. Sure, we offer insurance, and I look at it as a cherry on top, but the best form of insurance, and I can explain why ours is different, but at the end of the day, the best form of insurance is the way cryptographic material is held. And so I'm convinced that over time, you'll be able to create we've talked to firms about these mutuals, these insurance products where you can hold them in multi-institution custody. It'll be natural for institutions to participate in this that already have Bitcoin exposure, because they've already had to underwrite the notion of multi-institution for their own holdings. That'll propagate over into them participating into some of these mutuals. And now you can start to really develop robust Bitcoin denominated insurance markets, which will naturally also fill into this credit rating. So I think we're just very early, but it's an important thing that's been brought up, that the credit problem is or the credit rating problem will only increase as a natural point of friction as the market grows.
100%. I think it's definitely a positive signal that, at least we're talking about this stuff more. I think for a while, the sort of concentration risk, particularly as it relates to Coinbase being the custodian of 9 out of the 11 ETFs, is something that's just generally not spoken about. Like, everyone recognizes it as a really important risk, but it's really not talked about. And so the rating agencies talking about this in the context of treasury companies, I think just flows through to all elements of custody and people recognizing that, these proxy exposures come with real risks. And so you have to consider those as you're making your allocation to the asset. How do you actually want to hold it? Do you want to do it through a proxy where there's layers of counterparty risk and potential credit-related insolvencies at the underlying level, or do you want a more direct exposure where you have greater assurances of your ownership?
Yeah, and the crazy part is you can see it playing out this way from a very simplistic view of it's already kind of happening, where nobody ever gets fired to go into Coinbase and maybe a little bit of Fidelity. So if you just look at this, you just need one treasury company or one large custodian to mess up, and then you're back. So like, it can be, again, like the treasury company is an easier example because it can be a small amount of BTC, but at a public treasury company that's well known, has influencers, whatever. And then now everyone starts to just think, which they already should have, of like, how are they custodying? Are they trying to generate yield from it? But if you take it a step further, well, that naturally starts to move the market to where it's already going of like, okay, well, it needs to go at Coinbase because of X, Y, and Z reason. But that in itself it's this natural paradox of the more successful Coinbase is, the more likely they are to fail. And from a just pure first principle perspective, this is how gold failed, because ultimately, if you end up with a centralized asset, you end up with too many claims on it, and then you can't actually audit it. And you end up in a whole slew of other problems. But the other side of it is just the ROI starts to grow for the honeypot for that asset. And so there's just multiple forces that will like naturally push people in this direction. And it ties back to the Warren Buffettism of the whole notion of the definition of like risk management is, just like, it's such a great, like, it's a crude example, but he references if you're going to offer him $1 billion, But he has to play Russian roulette. But here's the kicker: it's like 1,000 bullets. You can make up whatever number of, or not bullets, but 1,000 spins in the chamber. But you have one bullet. Well, you would never take, like, no rational person would take that chance, because if you click the wrong, trigger once, you pull the trigger once wrong, you're out of the game. And it's very similar with custody. It just takes one time and you lose all the money. And so this is just, again, we're so early and there's still so small allocations that nobody talks or discusses this. But as the price rises, the allocation becomes greater, and then the confidence and conviction of the education becomes greater, that this is just the rational outcome for market participants.
Well said. All right, boys. We got through a lot. I think we got through all the links, got through the reports. We'll put those in the show notes. Anything else before we wrap?
No, I think we're going to be out on the road hosting events. So if anybody's interested in meeting the guys or the team, us one-on-one, we're going to be hosting some private dinners and some other roundtable events. Please reach out. Either you could shoot all of our names at earlyriders.com, or schedule time with the Onramp team and let them know that you're interested in joining. There'll be some stuff in Nashville next month, and then Dallas in October. But I think it's going to be a busy 18 months. So, reach out. We always want to connect. And then I think we'll be taking better logs of kind of who's in certain markets as we're around the country, and actually outside of the country, try to set up more roundtables and things where we can all connect with listeners and clients that are, partnering with us.
Sounds good. All right, boys. See you next week.
Thanks, guys.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.